What happens when the world's most powerful financial institutions suddenly need $85 billion in emergency funding? And what does it have to do with silver, a metal that has been quietly traded for thousands of years? We're witnessing something extraordinary in financial markets right now. Major banks have tapped the Federal Reserve for massive emergency loans, and many analysts believe this is directly connected to massive losses on short positions in silver. This could be the beginning of a fundamental restructuring of how precious metals are traded and valued. In this deep dive, we're going to unpack exactly what's happening, why it matters, and what it could mean for the future of banking, precious metals, and your financial future. We're talking about financial institutions borrowing money from the Federal Reserve's emergency lending facilities. Think of the Federal Reserve as the bank for banks. When commercial banks run into liquidity problems, they can turn to the Fed for short-term loans. Under normal circumstances, banks borrow from each other in what's called the interbank lending market. But when a bank faces a sudden cash crunch or needs funds urgently, they can access the Fed's discount window, a lending facility that has been around since 1913. The fact that banks have borrowed $85 billion tells us something important. These institutions are facing serious liquidity pressure. They need cash, and they need it fast. Now let's talk about the silver side of this equation. A short position is a bet that an asset's price will fall. Here's how it works. A trader borrows silver or contracts representing silver and immediately sells it at today's price. Let's say 30 per ounce. They're betting that the price will drop to $20 per ounce. If they're right, they can buy the silver back at $20, return what they borrowed, and pocket the $10 difference as profit. But here's the catch. If the price goes up instead of down, the losses can be catastrophic. If silver jumps to $40 per ounce, that trader now has to buy it back at a $10 loss per ounce. And unlike a regular investment where your maximum loss is what you invested, short positions have theoretically unlimited loss potential. The price could go to $50, $60, $100, or higher, and the short seller is on the hook for every dollar of that increase. Silver occupies a fascinating position in global markets. It's both a precious metal and an industrial commodity. While gold is primarily used for jewelry and as a store of value, silver has thousands of industrial applications: solar panels, electronics, medical devices, water purification, batteries, and more. This dual nature makes silver supply and demand dynamics particularly complex. The industrial demand provides a fundamental floor for prices, while its monetary history and precious metal status attract investors seeking inflation protection and wealth preservation. The silver market is also relatively small compared to other commodities. The entire above-ground silver inventory is worth a fraction of the gold market, and just a tiny percentage of the stock market. This smaller size makes silver more volatile and potentially more vulnerable to supply squeezes. For years, major financial institutions have been heavily involved in the silver market, primarily through derivatives, financial contracts whose value is derived from the underlying asset. Banks act as market makers, facilitating trades and taking positions on both sides of the market. Some analysts have long alleged that certain banks have maintained persistent short positions in silver to suppress prices and profit from the metal as manipulation. Whether this constitutes genuine manipulation or simply normal market-making activities has been debated for decades. What's not debatable is that these positions are enormous. Through futures contracts, options, and other derivatives, banks have exposure to billions of dollars worth of silver. The Bank for International Settlements reports that the notional value of over-the-counter precious metals derivatives runs into the hundreds of billions of dollars. Several factors have created a perfect storm for silver shorts. Physical demand has surged over the past few years. Retail investors have been buying coins and bars at record rates. Industrial demand, particularly from the solar industry, has been climbing steadily. Meanwhile, mine production has been relatively flat. Remember the GameStop saga of 2021? That same energy turned towards silver. Online communities, particularly on Reddit's Wall Street Bets and Wall Street Silver forums, began coordinating to buy physical silver and silver-related securities. Their stated goal: squeeze the short sellers. The global supply chain disruptions of recent years have affected silver mining and refining. Getting physical metal from mines to refineries to consumers has become more challenging and expensive. More investors have turned to precious metals as a hedge. This has increased investment demand for silver significantly. Most silver trading doesn't involve physical metal at all. It happens through paper contracts, futures, options, and other derivatives. For every ounce of physical silver, there might be 100 or more ounces of paper silver traded. The system works fine when everyone trusts that the paper represents real metal that could be delivered if needed. But what happens when people start demanding physical delivery? This is the nightmare scenario for banks with large short positions. They must buy it on the open market at whatever price necessary, creating a feedback loop where higher prices force more buying, which drives prices even higher. Before banks started tapping the Fed for emergency funds, there were warning signs throughout the silver market. The premium, the amount buyers pay above the spot price for physical coins and bars, reached historic levels, while spot silver might be trading at $25 per ounce. This divergence between paper and physical prices suggests severe tightness in the physical market. Dealers reported wait times of weeks or months for certain products. The U.S. Mint rationed silver eagles to authorize dealers. The COMEX, the primary exchange for silver futures in the United States, saw significant withdrawals from its registered and eligible inventory. This metal leaving the exchange raised questions about whether enough physical silver remained to back the outstanding contracts. The basis, the difference between futures prices and spot prices, widened dramatically at times, another sign of stress and dislocation in the market. Now we arrive at the headline figure, $85 billion in Fed borrowing. While the Federal Reserve doesn't publicly disclose which specific banks are borrowing or exactly why, the timing and magnitude of this borrowing has caught the attention of market observers. $85 billion is not a trivial sum. To put it in perspective, that's more than the GDP of many countries. It's roughly equivalent to the market cap of major corporations. For banks to need this much liquidity, simultaneously, suggests something significant is happening. Analysts who have been tracking the silver market believe this borrowing is connected to margin calls and collateral requirements related to short positions. Here's the mechanism. When you hold a short position, you must maintain margin, essentially collateral, that ensures you can cover your obligations. As the price of what you're short moves against you, you face margin calls requiring you to post additional collateral. If silver prices have been rising sharply, banks with large short positions would face enormous margin calls. Rather than close their positions at a massive loss, which could itself drive prices even higher in a vicious cycle, banks may be borrowing from the Fed to meet these margin requirements, hoping to ride out the squeeze and avoid a catastrophic unwinding. The sequence typically unfolds like this. Large short positions accumulate, either because traders are genuinely bearish or because they're engaged in other strategies like hedging or market making. Then something causes the price to rise. Maybe good news. As prices rise, short sellers face losses. Some decide to cut their losses and buy to close their positions. This buying pushes prices higher. Higher prices trigger more margin calls on remaining shorts. More short sellers are forced to buy to close positions or post more collateral. Each wave of buying drives prices higher, triggering the next wave. Eventually, either the shorts are exhausted, new shorts enter seeing an opportunity, or buyers become exhausted and take profits. The price peaks and often crashes back down dramatically. Silver squeezes have unique characteristics that make them particularly dangerous for short sellers. Unlike stocks, where companies can issue more shares, you can't print physical silver. This hard supply cap means that a squeeze key can't be resolved by simply creating more of the asset. Many industrial users need silver for their products. If they get caught in a squeeze and can't obtain metal, this creates additional pressure and urgency beyond normal financial market dynamics. The futures market relies on most contracts being cash settled rather than physically delivered. If a significant percentage of contract holders demand delivery, the system can break down. There may not be enough physical metal available to satisfy delivery demands. If short positions are concentrated among a small number of players, as some analysts believe is the case with silver, the risk of a catastrophic squeeze increases. These players can't all exit at once without driving prices through the roof. The most famous occurred in 1980 when the Hunt brothers attempted to corner the silver market. They accumulated massive positions, driving silver from around $6 per ounce to a peak of $50. When regulators changed the rules and margin requirements, the Hunts couldn't meet their obligations. Retail investors coordinated buying that drove silver from around $25 to nearly $30 in a matter of days, though it didn't sustain those levels. What makes the current situation potentially more significant is the combination of factors: retail investor coordination, genuine supply constraints, surging industrial demand. If major banks are indeed facing losses on silver shorts large enough to require $85 billion in emergency Fed borrowing, the implications extend far beyond the silver market. It raises questions about what other positions these banks hold and what other risks they're exposed to. If they misjudged the silver market so badly, what else might they have misjudged? This situation highlights the ongoing challenge of derivatives markets. While derivatives serve important hedging and liquidity functions, when banks take large speculative positions and face losses, turning to the Fed for support creates moral hazard. It signals that institutions can take excessive risks knowing the Fed will provide a backstop. If allegations of price manipulation have any merit, and banks are now facing consequences, the optics of banks needing bailouts after betting against a commodity desired by retail investors will fuel populist anger. This crisis could fundamentally reshape how precious metals are traded. The divergence between paper prices and physical availability could lead to a permanent reevaluation. Markets might evolve towards separate pricing for paper contracts versus physical metal. COMEX and other exchanges may face pressure to reform position limits, margin requirements, and delivery mechanisms to prevent future squeezes and ensure contracts remain backed by physical metal. Institutional investors might move toward physically backed products like ETFs with allocated metal or direct physical holdings rather than derivatives exposure. What happens in silver often affects gold, and vice versa. A silver crisis could spill over into gold markets, potentially affecting central bank reserves and international monetary arrangements. Beyond markets, this situation has broader significance. Silver's industrial uses mean higher prices feed into production costs across many sectors. The narrative of retail investors squeezing institutional shorts plays into broader anti-establishment sentiment. Success in silver could embolden similar campaigns in other markets. Intervening to protect banks might be seen as rigging markets against retail investors. Not intervening might risk systemic instability. If the Fed is providing massive liquidity to banks facing commodity market losses, it complicates the central bank's messaging around inflation fighting and monetary policy normalization. Several scenarios could unfold from here. If physical buying continues and banks can't source enough metal to cover positions, prices could spike dramatically, potentially to $50, $75, or even $100 per ounce. Another possibility is a managed resolution, where regulators and banks work together to manage an orderly unwinding of positions. This might involve rule changes, settlement negotiations, or even government intervention to increase supply. Prices rise, but in a controlled manner. The squeeze could also fail. Industrial users find substitutes or delay purchases, or this crisis could become a catalyst for fundamental reform of precious metals markets, including new regulations, exchange rule changes, and a shift toward blockchain-based settlement and ownership verification. Continued or increased Fed discount window borrowing suggests ongoing stress, while a decline suggests the crisis is easing. We should watch COMEX inventory levels, registered and eligible silver stocks, as significant declines suggest physical tightness. Physical premiums over spot are another key metric. Widening premiums indicate genuine shortage, while narrowing premiums suggest stress is easing. Bank earnings reports should be scrutinized for unusual losses or write-downs in commodities trading divisions. Any emergency rule changes, position limit adjustments, or margin requirement changes from regulators signal official concern. Price action matters too. Sustained moves above key technical levels, especially above previous resistance around $30, could trigger accelerated short covering. If the situation becomes critical, authorities have several tools they might deploy. They could change margin requirements. Increasing them makes it more expensive to maintain short positions, potentially forcing closures, while decreasing them provides relief to shorts but might encourage more speculation. Imposing or tightening position limits on how large a position any single entity can hold could reduce concentration risk. Forcing contracts to settle in cash rather than allowing physical delivery could alleviate physical supply pressure, though it would be highly controversial. The Fed could expand lending facilities specifically for commodity-related margin needs, essentially a bailout for shorts. The U.S. government could theoretically release silver from strategic stockpiles, though these are limited and such action would be unprecedented. Whether you're directly involved in precious metals or not, this situation has implications for your financial planning. This crisis highlights why diversification matters. Having some exposure to hard assets that can't be printed or digitally created provides insurance against financial system instability. If you own paper silver through ETFs, futures, or certificates, understand whether you have claim to actual physical metal or just a contractual promise. In a crisis, that distinction matters enormously. The premium on physical precious metals reflects not just supply and demand, but also the value people place on holding assets outside the banking system. For some portion of wealth, this premium might be worth paying. Regardless of how the silver situation resolves, the underlying concerns about currency debasement and inflation that drive people to precious metals remain. Consider what role hard assets should play in your portfolio. When markets become dominated by derivatives and paper trading, prices can disconnect from underlying physical reality. Eventually, this disconnect must resolve. The Reddit-driven silver squeeze demonstrates that coordinated action by many small participants can challenge large institutional players. This dynamic will likely appear in other markets. How authorities respond to this crisis will reveal whose interests they prioritize. Watch carefully how rules are enforced and changed. The fact that large banks can face existential threat from movements in a single commodity market shows how fragile our financial system remains despite post-2008 reforms. Banks in trouble can mean credit crunches, economic slowdowns, and potential taxpayer bailouts. The stability of financial institutions affects everyone. Each crisis that requires intervention erodes public trust in financial institutions and regulators. This has political and social consequences that extend far beyond markets. If retail investors successfully squeeze institutional shorts, it represents a rare wealth transfer from sophisticated players to regular people. Conversely, if authorities intervene to protect institutions, it reinforces perceptions of a rigged system. This crisis might accelerate adoption of blockchain and cryptocurrency solutions for asset ownership and trading, potentially disrupting traditional financial intermediaries. The silver short squeeze and banks' need for Fed support is symptomatic of broader issues in our financial system. Financial institutions have become addicted to leverage, borrowing to magnify returns. Now, while this works in calm markets, it creates catastrophic risk when positions go wrong. Most people, including many policymakers, don't understand the complexity of modern derivatives markets. Markets have become dependent on central bank intervention, creating an environment where risk-taking is encouraged because losses will be socialized. The gap between financial asset prices and underlying physical reality has grown. When this gap becomes too large, violent reconciliations occur. Should banks be allowed to take massive speculative positions in commodity markets, or have they become primarily speculative vehicles? How can we ensure price discovery reflects physical supply and demand rather than paper trading? What reforms would make the financial system more resilient to these kinds of shocks? Should there be greater transparency around large positions and who holds them? Or does it encourage moral hazard? Distributed ledger technology could provide real-time settlement and verification of metal ownership, reducing the disconnect between paper and physical. Digital tokens representing specific physical metal holdings could combine the convenience of electronic trading with the assurance of physical backing. Better data collection and reporting could give regulators and market participants earlier warning of dangerous concentration or excessive leverage. New trading platforms might emerge that emphasize physical settlement and transparent. The spectacle of major banks tapping the Federal Reserve for $85 billion in emergency funding, potentially due to losses on silver short positions, represents more than just a market story. It's a symptom of fundamental problems in our financial system and a possible inflection point for precious metals markets. Whether this is the beginning of a major crisis or a temporary disruption that will be managed and forgotten, we're witnessing the collision of several powerful forces: retail investor coordination, physical commodity constraints, institutional leverage, regulatory challenges, and questions about the nature of money and value themselves. For decades, critics have warned that precious metals markets were manipulated, that paper trading divorced prices from physical reality. Now, regardless of whether manipulation occurred, we're seeing that the underlying dynamics these critics identified were real: concentrated positions, leverage, physical supply constraints, and the potential for severe market disruption. The resolution of this situation will tell us a lot about the future of markets in the financial system. Will authorities intervene to protect institutional players? Will retail investors succeed in forcing a short squeeze? Or will the system absorb this shock and continue largely unchanged? Whatever happens, this moment serves as a reminder that beneath all the complexity of modern finance, the derivatives, algorithms, and electronic trading, real physical assets still matter. You can create infinite paper claims on silver. For individuals navigating this environment, the lessons are clear. Understand what you really own. Recognize the difference between claims and physical assets. Diversify thoughtfully, and stay informed about the systems that affect your financial life. The silver short squeeze story isn't over. The coming weeks and months will reveal whether this is a footnote in financial history or the opening chapter of a larger transformation. Pay attention. What happens with silver may well be a preview of dynamics that will play out across other markets and assets in the years to come, as once again teaching modern finance a lesson about the limits of paper promises and the enduring reality of physical scarcity.